Hey guys, welcome to this Sunday edition of the weekly market preview, where we sort of step back a little bit and sort of look a little bit what's going on with the macro sort of situation and markets overall. Some great news for the macro shop that Nick is now going to do a daily sort of technical analysis update video in the morning. So he'll do a more comprehensive version on Monday morning to start the week, and then sort of Tuesday, Wednesday, Thursday, Friday we'll do a sort of a bit of an update video every morning. So that's great. I'll be focusing on sort of the macro overview and what's going on with markets, and Nick on the technicals, and we'll also both be looking at trade setups and everything. So that's starting from tomorrow. Okay, so let's just have a look and just see. So what we got last week, just while I'm sort of looking at this, let's just sort of see what's going on here with the Fed path. But what I want to say here is that last week we got a sort of a little bit of a read on the situation in the US in terms of inflation. Clearly, the inflation numbers, both the PPI and the CPI, overall came in sort of relatively well, sort of relatively benign. Having said that, there's a couple of important caveats or things which we should keep in mind, is that the headline inflation for the CPI is still 3.4, which is well above the Fed's target, of course, and that the more hawkish members of the FOMC, like Beth Hammack and whatnot, they are still sort of wanting to hike and not at all happy that CPI headline is still over 3%. The other issue is that if you look at the PPI, a lot of the numbers were quite positive in the sense they came down a little bit, but some of the sort of the subcomponents are still, let's just call it sticky, even rising. So what we can take away from the inflation situation is that it is perhaps stabilizing, perhaps coming down a little bit, but there's still a little bit of stickiness. And of course, the big unknown is the oil situation and the energy complex in general, especially the refined products, which I keep on sort of, banging the drum about, like sort of dieseline and jet fuel and heating oil and also gasoline a bit. All of this sort of refining capacity has been taken, oh, not all of it. Some of the refining capacity has been taken offline because we're still continuing to see Ukrainian attacks, serious attacks on sort of very large sort of Russian refining sort of complexes. We're also seeing the Houthis continuing to attack Saudi Arabian refining complexes, and just generally in the Gulf states, there's been quite a lot of damage. So the point is that global refining capacity is still down, from what I'm reading, 10 or 15%, something like that. And therefore, that's putting a squeeze on the availability and the cheapness of the refined products. And that's why we're seeing jet fuel and, as I said, sort of heating oil and diesel sort of remaining at very high spreads, which of course is making the crack spreads high. So the difference between, crude oil and the final refined product price, which of course is great for refiners. Anyway, so the point is here is that inflation, with this sort of the big question mark about where does sort of the energy complex and the refined crude products go as a big question mark. But overall, it seems to have given the market a little bit of a reason for pause. On the other hand, if we look at growth, we got retail sales, which actually came in sort of fairly, shall we say, weak, definitely sort of lower than market expectations and a little bit weak. So putting those together, slightly sort of soft, or even, let's just call it reasonable inflation data and a softer retail sales. Also on Friday, we got the University of Michigan consumer confidence numbers, which came in a little bit on the weak side. So could it be that the US economy is moving into a situation where the labor market is stable, but not really, not a lot of new jobs are being created. There's not a lot of new hiring. On the other hand, employers are not really firing people. So it's kind of like a stable labor market with, as we know, sort of low replacement rate because the immigration rate is very low. We have a sort of a growth situation, which is starting to show potentially a few cracks, a little bit of a slowdown potentially. And I actually posted on the community, you guys remember, on Friday, for the first time in a long time, we're starting to see the higher income earners actually starting to spend a little bit. So does that mean that people in the middle and the sort of middle high sort of echelons of income are starting to pull back a little bit? Because we continue to have very sort of elevated prices, and maybe that's going to be a bit of an issue. So really what the market is sort of, the real economy is saying is, definitely not a recession, but potentially, a slower rate of growth. Let's put it that way. Not necessarily even a slowdown, but a slower rate of growth. And so getting back to sort of the market reaction to all of this, that gave the permission to the markets to price in a less aggressive pricing for the Fed. So what we can see here, I put the benchmark basically a week ago. So it's last Friday, I think. Sorry, not last Friday, but the Friday before. So basically, there's essentially a week ago of trading. And what you can see here is this is the future path of the Fed as priced by the market. So the total move was still at about 38 basis points. So as you guys know, one hike would be 25 basis points. So that's about 1.5 hikes still priced in. And we're still looking at a terminal rate, so the end rate of just over 4%, and currently the effective Fed funds rate, which is the overnight rate, is 3.63. So the market's still pricing in, saying, well, hey, we're here at 3.63%. We think we're going to get up to there. Now, is this dovish or hawkish? For sure, we've come down a lot in the last month. When I say come down, it's much more dovish, and that should be a positive thing for equities. And you can see here just in the last week, if you look at the various sort of 3-month chunks here, you can see that we've come down 3, 5, about 3 to 5 basis points overall. So we've taken it out about a 20% a chance of a hike. And if you actually look here at the individual meetings, those of you trading short-term interest rates like Fed Fund futures and SOFR, you can see here that for the September meeting here, we're pricing in about sort of 8 basis points. So as you can see, 8 out of 25, that comes to about a 1 in 3 chance of a hike. So the market hasn't completely given up on the fact that the Fed will hike, because keep in mind that we're still going to get some CPI data and employment data before then. And let's say, for example, that's super hot and higher than expected, that number could go up. But it seems to me that also politically, I mean, we all know that Trump wants lower rates, and we all know that Kevin Walsh, although, he's protested that he's very independent and the Fed is independent, okay. What we're saying now is that with this sort of slightly softer non-farm payrolls we got, like what was that, 10 days ago, 2 weeks ago, the inflation data, CPI, PPI, a little bit, sort of a little bit softened, and the retail sales, it does seem that this has given quite a lot of sort of cover or a justification for the Fed, especially Kevin Walsh, to not hike in September. So one could argue here that this number of plus 8 basis points will come down, by the time we get to the 16th of September, could come down to like 1 or 2 basis points. So, maybe a little bit of a trade in there. But having said that, the market is still, as we saw previously, pricing in cumulatively out to the sort of the middle of 2027, about 38 basis points. So it's not as though the market is definitely not pricing in cuts in any shape or form. And it still, hasn't given up on the idea that the Fed will be hiking once, 1.5 times, so to speak, maybe even twice here. Now, again, just looking specifically at the SOFR curve, again, if you look at the benchmark, which is about a week ago of trading, again, a similar kind of situation here to what I showed you in the Fed sort of implied sort of forward rates there. You can see that that's come down a little bit. The dotted line is where the benchmark was a week ago, and you see that that's come down basically at the front of the curve here. So you're looking at September and December 26th, we've come down 3 to 5 basis points. And then even if you look at March 27 and June 27, come down about 5 basis points. So that's where we're at. And just finally, just to sort of to complete this, you can see here on the Fed funds futures, which is not the 3-month contracts, but the 1-month contract. So it's actually much more precise when looking at FOMC meetings. You can see that also in the benchmark, that's also come down. So you see we were at this sort of dotted light purple line, and we've come down over the whole curve here. And if you look at something like if you look at September 06, exactly for the Fed meeting, we've come down 1.5 basis points, a little bit. And then if you go further out the curve, so you go sort of September, October, November, and December, it's more like the 5 basis points. So bottom line, yes, the market has looked at the non-farm payrolls, the market has looked at retail sales, the market has looked at inflation, and basically said, hey, you know what? Inflation is sort of stabilizing. Let's just put it that way. Not perfect, sort of stabilizing, maybe softening a little bit, and maybe growth, jobs, and let's say retail sales, people's consumption is flatlining a little bit. So if we look then at the bonds, that should give us like lower bond yields, right? So let's now look at the bond yields. And again, got a benchmark. Well, again, this goes back a little bit here. It's like, so what you can see is the effective Fed funds rate which is 3.63, which is this orange line here. And you see here the Fed cut, and then they've been on hold for a little bit. Now, the big question is, of course, are they going to hike, once, one or two little steps upwards? But what we can see here, if you look at the yields, is that what I just said, that the front end of the curve has basically believed that narrative I just talked about. So inflation sort of coming down or certainly stabilizing, maybe consumption stabilizing, maybe even coming down and weakening, and the job market okay, but maybe softening around the edges. So that would argue for lower nominal yields, right? Well, yes and no, because what we're seeing here is at the front end of the curve, so this is the blue line, you can see here that's starting to come down. Then you can see this sort of a pale sort of the 5 year, which is this sort of pale sort of aqua turquoise, that's also coming down. But once you start getting sort of in the belly of the curve and higher up with the tenors, the longer tenors, so the 10 year in the purple here and the sort of lime green, of course, what you see, you can see that they're actually going up. So quite a sharp divergence here. So what's basically happening, and we're going to look at that, is that we're getting a steepening of the curve, which essentially means that, the curve is going like this. So the back end yields, so the 10s and the 30 nominal yields are going higher, and the front end yields are coming down. Now, the front end yields are coming down plausibly because they're looking at the Fed's reaction function and that stuff we just talked about. But then if you look at the real yields, and what we've done here, we've got the sort of the nominal yields, and then you subtract the inflation expectations, and you can see again that at the real yields for the front end of the curve, like the 2s and the 5s, indeed have come down a little bit. So that should be a positive for consumption and the real economy. But the reality is that most people's, their car loans, their sort of mortgage, the average mortgage in the US now, I think it's about 6.7% on a 30-year mortgage. The same in Canada. So the point is that mortgage rates and sort of, business loans generally, in the 5 to 10 year range, and personal credit cards, all this kind of stuff. A lot of this stuff is not really based on the 2 year yield or the 12-month yield. It's based more on the 5, 10, or even the 25 or the 30-year yields. And as you can see here, the real yields here, those nominal yields have kept very elevated, even going higher. And even if inflation expectations maybe are sort of stabilizing, the problem here is that the real yields at the back end of the curve, let's say from the 7 out to 30 year, is still remaining flat, even more elevated, and in a historical sense, very elevated. And that's a problem potentially for some of these sort of tech stocks, which are long duration stocks. Now, the other issue is here, if we look at inflation swaps, which is what the market, basically is trading, what the market implies, you can see again that, it's come down a little bit over, it's kind of stabilized here, and at the front end, it's come down a little bit, but it's still, really above what the Fed wants to be seeing. So the question here is like, well, okay, what's going on? And basically, in terms of this sort of vicious steepening, let's now look at a few charts. This is going to have some big consequences. It's going to be really much the story of, has been the story. So again, if you look at the front end of the curve, you can see the 1 year yield, you see that they've come down a lot. And again, I think part of that story is, softening labor market, maybe softening sort of consumption, retail sales, and maybe an inflation inflation indications, which are sort of maybe stabilizing, maybe even coming down a little bit. Or even though the energy complex, which is remaining a bit stubborn and sticky, it's not as high as it was in the peak of the war. So you see the front end of the curve is saying, okay, it's giving permission to maybe be more dovish vis-a-vis the Fed. Then if you look at the 2 year, you can see that's also coming down a little bit. Although maybe we've reached a little bit of a maximum here. You see on Friday, it was kind of, we topped out at that, so we bottomed out at that level there at about 4.11. So that was a nice buy on the ZT. By the way, guys, a trading note here. For those of you trading things like ZT, ZF, the bond futures, if you want to be doing this kind of stuff, obviously we need to be looking at the price levels, but your first port of call, so to speak, should be the charts for the yields. Institutions trade on yield levels. And then you say, well, okay, if I want to sort of sell or buy the yield, so to speak, you then kind of look at the price charts and figure out what's going. Okay, so this is very important. There's a bunch of technical reasons for that. And again, I'm not saying ignore the price levels, because obviously at a certain point, you need to know the price. But your real first thing is to say, well, where's the 10-year yield? Where's the 30-year yield? Where's the 2 year yield? And you see here on Friday, for example, that we're getting down to a little bit of sort of horizontal support, so to speak, for the yields. So maybe that marks a little bit of a short-term low, in which it's like the market is saying, hey, that maybe we're done being dovish with the Fed. You start to see a push up in the yields. And then you say, well, okay, where was this level in the ZT pricing? And that would represent your entry point. Just a bit of a trading tip there. Okay, so we're getting back. So again, let's just relook at this. You see the 1 year yields come down quite a lot. Then the 2 year, okay, but look at the 5. The 5, not nearly as much, and then you look at the 10, basically trading in the middle of the range, and you look at the 30. So you see whoosh. Now, of course, this is basically a steepener, and we can see what that looks like. And it's basically steepening all along the curve. Even the 2s to 5, you go, well, hold on, that's only like a few years. And essentially what that's saying is that the 2 year yield, which is very sensitive to where we think the Fed is saying, okay, maybe the Fed's not going to be that hawkish and not hike that much, but we do believe that, overall, the direction of travel a bit further out needs to be, we need to have sort of slightly higher yields. And of course, that becomes even more marked if you look at, let's say, the 2s to 10, you look at this crazy steepening here. And if you look at the, let's say, the 2s 30s, you see that very, very clearly. Now, the question is, you say, well, why is this happening? It's like, if, if the economy is weakening, maybe the economy is softening, maybe the employment situation is worsening a little bit, maybe the Fed's being more dovish, inflation. But the point is that what we can see here is that there's also a question of credibility, right? And so it seems to me that the market has two narratives at the moment. The front end of the curve is basically saying, okay, we believe that the Fed maybe is not going to be as hawkish, and so we'll pull in the front end yields a little bit. But and we see this, for example, if you look at the FOMC meeting, the Fed meeting on the 17th of June, Walsh's first, he came in and wagged his finger and said, I'm going to be very strong about inflation, and the Fed is very serious, and we take our credibility seriously, and we're going to slay the dragon of inflation. And so the market believed him, and the curve flattened. Now, what we mean flattening? It means that the front end yields in this occasion went higher, and the back end yields went lower, so the curve flattened. But since then, there's been a sort of a slow erosion of credibility, I'd say. And you can see here that if you look at his last meeting, you can see that ever since that happened, basically we've had a steepening of the yield curve. Now, why is that? Why is the back end? It's almost as though the back end yields, the long-term yields, the 10-year, the 20-year, the 30-year, they're not believing this narrative. So that seems to me that basically what's happening here is that it's like a bit of a lack of credibility in the Fed. It's saying, we don't believe that the Fed is actually serious enough about combating inflation. And even some of the Fed members themselves, as we saw, like Beth Hammack and Kashkari, for example, are saying, guys, we've got to start hiking interest rates. Like literally some members of the Fed are saying, we need to start hiking interest rates now. So if the market has a bit of a credibility issue about that, it's going to say, well, okay, we are going to price in a bit of risk premium. We're not saying that that inflation will rise to 4 or 5% over the next 10 or 20 years, but we're saying we're not sure that the Fed's going to be serious about it. So we have something called risk premium. So the market will just, sort of mechanically, mathematically just start raising a bit of interest or pushing up the yields to cover themselves for the inflation risk. We also see that in oil complex and the energy complex in general, as we saw, is not necessarily coming down a sort of medium term. Now, maybe it's not going to go up to $125 a barrel, but the point is, no one is really saying at this point that oil is going to get to pre-war levels, down to $50 or $60 on WTI. It looks as though there's like the new normal is going to be 70, 75, $80. And that, at the end of the day, is making energy and all of the infrastructure around that, and transportation and logistics and the cost of insurance and the cost of packaging and plastics and everything more expensive. At the end of the day, it's not deflationary, right? We also, of course, have issuance and we have deficits. The US deficit is out of control. It's about 7% of GDP. You do realize, guys, that that's the highest it's been ever, except for a crisis situation like World War II, or let's say the Korean War, or let's say COVID or something like that, or the Great Financial Depression, the Great Financial GFC, the Great Financial Crisis, right? The point is that we're not in that situation at the moment. We don't have a world war. We don't have a pandemic. We don't have a massive global financial crisis. So why is the US sort of deficit, government spending, at 7% of GDP, about 7% of GDP, which is incredibly high and a crisis level? And the market does not like it. There's constant issuance. There's too much deficit spending, right? And so that is all going to be reflected in the long end of the curve, which is pushing up those long end yields. And we saw that last Thursday. We had the 30-year bond auction, which came in at the highest yield, which is basically we've had for 20 odd years. Now, I'm going to put this in context, guys. If we go, or we'll have to go, I think, on a monthly chart. And there you go, guys. That's where we are on a monthly chart. You see my charts here. I have to go all the way back to, we're kind of getting back here, guys, to 2007, right? This is before the Great Financial Crisis. It's like 20 years ago. So you see here, by the way, it's going to be a very, very key level. Just keep that on your charts here for the 30-year, 5.39, 5.4. Let's call it 5.4, 5.39. If we get above, that's maybe a target where we're going, okay? If we get above there, you see just how far. This is a monthly chart, guys. Look where we are. We're getting very, very high. It looks as though this could break out, but for sure, that's a potential target. Point being that the market at the long end is saying, we don't trust the Fed. We're worried about their seriousness about fighting inflation. There's too much government issuance. There's also too much corporate issuance happening. All of the hyperscalers are essentially issuing hundreds of billions of dollars of bonds to pay for all of the capital expenditure and the data center, et cetera, et cetera, et cetera. And at the end of the day, this just means that there's a huge amount of supply coming into the market. So all of that means that this is putting pressure on the long end of the curve. And what's interesting, and I just want to draw your attention to this, if we look at this steepen up, so let's look at the 230s, and we see here that basically the day that Walsh sort of seemed to be sort of relatively sanguine, relatively relaxed about sort of hiking interest rates, and essentially said, hey, that's kind of like the bond market's job, and they're sort of doing it. The bond market said, okay, baby, you want us to raise interest rates, well, yields, we'll do it. I just want you guys to look back to Jackson Hole, because we have the very important, traditionally, as you guys know, late August, like what is it, the 28th, 29th of August in Jackson Hole, Wyoming, the central bankers all get together. And historically, that's been the place for a keynote speech by the head of the Fed. So the market's going to be very, very much watching what Kevin Walsh says there. But what's interesting, guys, I just want to draw your attention to Jay Powell. So you look here at his speech, Jackson Hole, and basically, if you go back to 2025, you can see that when he came out last year at Jackson Hole, which is here, the curve also kind of steepened quite a lot here, right? So the point is that once the curve can steepen, because basically last year at Jackson Hole, Jerome Powell came out and said, "Oh, we're kind of done. We know that inflation's a bit too high, but we're a little bit worried about the employment situation. It looks as though the labor market is softening." And the market said, okay, so you don't want to hike anymore. In fact, you're going to start cutting. Remember, they started cutting around about here, and the curve steepened. Not only that, look at that date there, because that date, which is like late August 2025, we kind of started to get a little bit, what people calling maybe like the debasement trade a little bit. And I want you guys to also observe here on the US dollar. If you look at the US dollar here, we also had a bout of weakness on the US dollar. Now, it wasn't super long-lived against other G10 currencies, okay? But the US dollar weakened. And maybe even more importantly, if you look at the gold, and this is the interesting thing, if you look at gold here, look at this, guys. I just want to draw your attention, very, very important. Jackson Hole was basically here last year when Powell said, now, one could argue, oh, it's just a technical breakout of gold. For sure, there was definitely some kind of sideways, sort of symmetrical triangle, consolidating pennant, whatever you want to call it. For sure, it's a technical breakout. Absolutely. I'm the first to observe that. But what I'm trying to say, guys, look at gold. Boom. That's when it broke out, because the market essentially said, okay, we now have a regime at the Federal Reserve where they're sort of putting inflation concerns to the side. They're going to be more dovish than is necessary. And therefore, they're going to, that's the debasement trade. So precious metals that's the beginning of the massive breakout. And let's have a look at silver. You can also see silver, where are we? Yeah, basically here, silver did have a bit of a dip, but of course we had this, but basically there's Jackson Hole there, the end of, I don't know, August, sorry, let me get my numbers right here. Basically about there's Jackson Hole here, right? So silver had a nice run up. It did dip a little bit because it has a higher beta. It's more volatile. And then of course had this crazy rip higher. The point being, guys, and I'm not saying, oh, this is what's going to happen, but just keep in mind what's happening here is that the steepening of a curve, when the labor market is, sort of not super strong. We had a little bit of a soft retail sales. Inflation is not necessarily ripping into new highs. Higher nominal and real yields at the long end and an aggressively steepening yield curve. That is a market telling you that it's concerned about the regime at the Fed. Okay, so it's going to be interesting to see what Kevin Walsh does. Whether he's going to sort of come down straight down the middle and say, no, we're still concerned about inflation, blah, blah, blah. If he's in any way relaxed, we will definitely get more steepening of the curve. And more importantly, this could be the beginning of sort of more debasement. And I'm just thinking, I'm definitely looking at what's happening with gold here. Now, again, I'm not saying gold's going to rip to all-time highs, but if the market gets any sniff that Kevin Walsh is not taking inflation seriously and is prepared to let the long end of the curve do the heavy lifting and lift rates, definitely we could get a serious upside in precious metals, also industrial metals, obviously the silver, but also I'm thinking, things like platinum could break out, palladium, and our dear old friend copper here, which had, a nice little bounce here off this sort of 50% here. Copper also could get a push higher. Now you say, well, what about the US dollar? And what I want to say, guys, is that keep in mind with the US dollar has stabilized quite a lot recently, right? But keep in mind that not against all currencies. The US dollar, and what I've got here, this is courtesy of Robin Brooks with the chart. I was watching his podcast. You see his bald head down here. But the point is here, if you look at the US dollar here, look at it against the trade weighted and the emerging markets. So what you can see here is that if you look at you've got here obviously you've got actually where Jackson Hole was and also where the tariffs came in. And you can see the US dollar against the G7, which is the blue, is this number here. So you see the G10 rather, you can see it against the G10. So the US dollar weakened a lot and it's kind of been stabilizing. So just be careful when you say, oh, the US dollar is strong. The US dollar against the other G7, G10 major crosses is, definitely was very, very weak in this period after the tariffs. And then also after Jerome Powell was a little more dovish than sort of liked by the market at Jackson Hole last year. But subsequent to that, the US dollar against the G7 and G10 currencies has kind of stabilized. One could even argue it's strengthened. But I want you to look, guys, also at against the emerging markets, which is the black. And you see here that it never really recovered. And if anything, it's, as we speak today, August the 16th, 2026, it's basically still sort of pushing lower. My point is that the US dollar has been debased globally, okay? And you could say, well, what's going on? And I would say that what's happening in the G7 and G10 economies, first of all, what's very important here is to think that what's happening in Japan is a big issue here. Because remember, when you look at the dollar index, the so-called the Dixie, remember that it's like 57% euro, as we all know. I think it's like 10% Japanese yen and whatnot. And so the point I'm trying to make here, guys, is that the US dollar on the dollar index, yep, it's just sort of, even strengthened. You can see here sort of been strengthening for a year against that, and then now in a nice little consolidation in a more shorter term sort of time frame. But if you actually look at it against the emerging markets, and let's maybe look at a few emerging markets here, just I call the emerging markets, let's say like US dollar Mexican. I mean, look at this, guys. I mean, I hope we're all looking at this. You see USD, this is a daily chart. I mean, look at that, guys. Straight down against the Mexican peso. Now, the South African rand is a little choppier, but the point is against the South African rand, this is weakness in the US dollar, et cetera, et cetera. So the point I'm trying to make here is that the US dollar has been debased a little bit. Gold did go up a lot against the US dollar, et cetera, et cetera. Okay, so that's all I'm trying to say here. That's the regime. So the point I'm trying to say is this week, keep a good eye on the steepening of the curve because it is giving us a little bit of information. And basically the regime we're in at the moment is what they call a twist steepener, where the front end yield, it's twisting. So the front end yields are twisting lower and the long end yields are twisting higher. It's not even that all yields are going up. The front end yields are saying, okay, the Fed maybe it's not going to hike as much, but it doesn't necessarily mean it's all good news. There is still some concern here. Okay, so if we just get back to a few different markets here, we don't have a huge amount of data this week. What we do have is we have the FOMC minutes coming out on Wednesday. So they're going to give us a record of the last meeting. So that's going to be interesting. But again, it's slightly stale news, although let's pass that. We have housing starts and we also have industrial production later in the week. Yeah, that's for sure going to be interesting. Housing starts. Let's see if the mortgages, the high elevated mortgage levels continues to put pressure on housing equities and also industrial production. But in terms of what we see, I actually just want to look at volatility, guys, because we have to put this all in together. So before we just talk about volatility, the thing about the equity market is that for the moment, the stocks are accepting a certain narrative. They're basically saying, hey, the cost of capital, nominal and real yields, is very, very expensive and getting more expensive. But it's okay because the earnings growth and the profit margins growth is outstripping that, is going faster, is growing higher. So that's kind of the equation we're in. On one hand, you've got the cost of capital, nominal yields, all of this kind of stuff, which is sort of a negative for these sort of tech stocks. But on the other hand, a lot of these sort of companies, they have, as I said, the earnings are very strong and actually growing. The return on investment, the ROI, seems to be relatively acceptable at the moment, even maybe improving. We're starting to see instances of return on investment. And so there's a sense that, hey, it's not perfect, but the earnings, the profit margin and return on investment is showing enough growth that we, for the moment, can put aside the high cost of capital. And, so therefore it's not particularly stressing. But we have to keep an eye on that because that could break at any minute. And then one thing to say was like, okay, well, is it breaking? And I just want to have a quick look here and look at just some credit. And I've got to say that credit is behaving quite well. So if we actually look at some of my ratios here, where's my credit? Oh, yeah. So if you look at credit here, I just want to look at the high yield space. So if you look at HYGH, which is the high yield space, versus LQDH, which is the investment grade, you can see there's no real panic here. And the higher this chart goes, that's essentially saying that high yield is sort of outperforming. Okay, it is outperforming the investment grade. So that's a positive. So I'm not going to play Cassandra here and ring the alarm bells for no reason, because high yield is not under pressure. But this is in the general sort of sector. If you actually specifically look at the credit default swaps specifically for some of the hyperscalers, they are starting to show higher yields. Okay, so it's not yet broadened to the broader sort of high yield junk bond community. But let's just keep an eye on all of that. That's what I'm trying to say. And by the way, guys, talking about sort of high yield, if you look at something like, let's say CLOZ, which is triple B rated as a bond ETF. Okay, so triple B rated, so technically junk bonds or not investment grade. I don't use the word junk in a pejorative sense. I'm just saying as an investment, as an indicator. This guy, the dividends, if you want some nice high dividends, this guy pays almost 9% per year. Now, of course, there's a bit of a risk with your capital. You see here, it is capable of going from, mid $20 down to, down $1 for sure. It's possible. But what I'm trying to say is that this guy does pay, pretty juicy yields, about 8.5 to 9% on an annualized basis. Just saying. So some of these are sort of, and as I say, if you want to look at like one way to sort of keep an eye on all this stuff is if you want to invest in some of that, if you can look at the where's my bonds here? If you look at some of these things like J and K, which is for the junk, you can see that it's actually going up, or HYG, which is also another junk bond kind of ETF. You see they're having quite a good moment. Now, can they have a bad moment? Absolutely. But at the moment, the market is not signaling sort of credit stress in a sense. So that's a positive at the moment. Let's keep an eye on it. Now, the other thing I want to talk about is volatility. So if we look at the VIX here, as you guys can see, the VIX here is at 14.2. Low. Now, keep in mind that approximately 16% indicates a 1% sort of daily sort of move. So this is indicating, like only about an 80, 90 basis point move in the SPX every day. So that's got to be a tailwind for equities. And what's pretty extraordinary to look at is actually, if you look at, I just pulled out some data this morning doing my research. If you just actually look at the put call skew kind of metrics here, and this is courtesy of Sharp 2, which does some great stuff on volatility. You can see here, normally puts are more expensive, right? People pay more for downside protection. So dealers sell puts much more expensively than calls, right? So normally the put skew is more expensive on the downside. But what's interesting at the moment, and you've had the duration, the tenor, so 7 days, 14 days. If we look at, let's say, the 30-day, which is kind of like the VIX, you can see here that in terms of Z scores, which is like standard deviations here, you can see that it's much, much lower here on the puts. These are the puts, right? You see that the puts here are much cheaper than they normally are by standard deviation, right? You see all this? See all this blue? It means they're cheaper. On the other hand, if you look at calls, which is over here, and again, this is percentage out of the money, so 40%, 30%, whatever, out of the money, you can see that the calls here, and let's again go with the 30 days, you can see that they're much more expensive. What is that telling us in simple English? In simple English, that's saying that the normal relationship of puts being more expensive, people paying for downside protection, is not happening at the moment, at least in the SPY. And actually, people are all in on buying calls. There's a massive amount of call buying. That's positivity. Is it too much optimism? Is it a bubble? I don't know. But just to say that, by the way, it is historically quite expensive to be buying calls. Also, by the way, this is a great time to be buying put protection. Any of you have a sort of a portfolio and you want some medium-term 3, 6, 12 months protection, historically, this is a pretty cheap time to be buying protection. Now is the moment to be buying sort of medium or long-term protection or even short-term protection if you feel that way because it's cheap. So the point is here, there's a lot of optimism is what I'm trying to say, guys. So we have very low implied volatility. We have a very bullish, maybe overly bullish, but we have a very bullish kind of put call skew. People are really paying up. And just keep in mind, guys, another interesting thing I'm looking at here, if you look at the distribution of where the VIX is, you can see at these levels. Remember, the VIX, as we saw, is down at about 14.5, as of last Friday. And you can see here that if you look at the close of the VIX, 14.5, guys, that only happens, around about 10, 11, 12% of the time. You see? So basically what it's saying, anything below, like, what is this, 50? The normal distribution here, as you guys can see, much much higher, 16, 17, 18. Now, of course, occasionally, rarely you get these very high ones, but most of the distribution, most of the time, the VIX is, around about 17, 18, 16, whatever, something like that. Very rare for it to be so low. Point is, volatility is low. People are all in buying calls. And hey, to be honest, that's a positive for equities. Now, as we saw, nominal yields are high, real yields are high. The distribution is not perfect in terms of the breadth, and we can look at the breadth here. Let's look at the S&P 500 percentage of companies over the 50-day moving average. That's going a bit higher. It's not too bad. Definitely not at 20%. We're up at 70%. So the SPY is not too bad. If you look at NASDAQ, not quite as good, but we've had a nice little breakout. So the breadth is not perfect, but we could say it's improving. If you look at the equal weight ETF, so RSP, kaboom. This is the one to be in, guys. So what's happening here is that we are getting a little bit of a broadening out of the positivity, and more companies are sort of participating. And it's not only your semiconductors, even though they've had a nice few days, SMH, it's not only your Mag 7s, which is still not an all-time high. So it is participating. So one could argue that overall, this is a pretty positive environment. You just have to keep your eyes on the bond spreads and let's say credit spreads, which is still, as I said, sort of okay, although we do have that steepening. So all that to say that I do think that, rather than ripping higher, there's no reason why we can't potentially grind higher, both in the S&P 500 and let's say in the NASDAQ as well. NASDAQ, as you guys can see, we broke that very key level of about 30,070. And there is a bit more upside towards 30,000, let's call it 600 or so. Nick will look at that in his technical analysis. But there is definitely a sort of more upside. We can see that the small caps, the Russell doing very, very well. This is a very bullish chart, guys. Like, look at these moving averages, all pointing sort of upwards. So no reason why that can't go a little bit higher. And something else which I'm looking at, again, this is not exactly a trade recommendation, but looking at the VXX, which is not a bad ETF to trade where you think volatility will be. So it's an ETF VXX, pretty liquid. This, as you guys can see, this more or less tracks the VIX. So obviously, generally, it's sort of going down because there's some technical issues. But what I'm trying to say is, well, the structure of it. But what I'm trying to say is that if you do believe that, over the next few weeks with maybe CPI, non-farm payrolls, the Jackson Hole Symposium coming up at the end of end of August, if you do believe that we could see a little bit more volatility and that this is maybe a little bit too low compared to what we could see, even geopolitical stuff, interesting one, maybe some call spreads, just some straight calls with maybe I don't know, maybe to the end of Jackson Hole, so maybe something like the first week of September or something like that. That's something I might be looking at tomorrow. Now, of course, it could just keep on grinding lower and you'll be theta burned by the time decay, but maybe buy some spreads or something like that, some call spreads. But I just think it's an interesting one. We could get, what you're looking for here is not a huge amount of upside. You're looking for, some kind of little pop here. Maybe we go up from, where we were, which is like, I don't know, VIX of 14.5 to a VIX of maybe 18 or 19, something like that. You're looking for a pop up here, this kind of situation here, something like that would be great. I'm not talking about all of this because obviously this was the war. But what I'm trying to say is if the something hits the fan, you know that this thing can really sort of go higher. But as I say, you're probably hoping or trading something like around it like this. If we get some, let's say, a lot of negativity, geopolitics, Jackson Hole, I don't know. There is a possibility this goes high. Just an interesting one to be looking out for. Okay, guys. What else? What else? What else? What else? Okay, just finally, as I say, we don't have a huge amount of data. I am keeping my eyes on a gold, as I talked about before. Again, it's this question of the real yields, and keep in mind that the real yields are actually coming low at the front end, but remaining sort of very sticky at the long end. But I think here, obviously, Nick will talk about it, but this is still a fairly constructive sort of price action. So a long period of sort of basing formation, had a bit of a breakout test, rejected at the downtrend, but we did break over the EMAs here. Now this is a simple moving average up here. We had a bit of consolidation, but the consolidation, if we break it down on a 4-hour chart, which is here coming up, you can see here that the market reacted pretty well. And essentially bought, if we just look at a Fibonacci, a basic sort of fib, well, which one we'll look at, let's say this one, just on the shorter term 4-hour chart here, you can see that we didn't even get down to the 38% here just from this recent uptrend. So that's quite positive. Let's see how we go Sunday overnight coming up and then Monday, but that's looking quite interesting. So that's what I'm going to be looking at this week. Obviously gold, silver, of course. Copper to me looks quite promising as well. And again, if we get strong industrial production, if maybe the curve can flatten a little bit more, the long end comes down a little bit. Maybe oil comes down a little bit. Volatility remains relatively low. We could get a slow grind up in this sort of fairly tranquil summer session with lower yields. And that, as I say, could be positive for the equities and maybe positive for our friends in precious metals. That's about it. All right, guys, I'm going to leave it there. Enough for a Sunday. I'll be back, as I say, probably about 7:30, 7:45 tomorrow morning with the daily macro snapshot. My colleague Nick, as I said, is going to do a sort of a comprehensive technical overview tomorrow morning, Monday, and then he'll be doing the daily technical analysis sort of snapshot, so to speak, every day this week, which is great. And of course, any event previews and random stuff during the day will be there. Thanks, guys. Hope that was useful. That's it. Thanks very much. Take care and have a great Sunday.